Joining us now for a deeper dive on the financial sector, let's bring in Devin Ryan at JMP Securities, Director of Financial Technology Research. Devin, good to talk to you today. We're going to get to the restructuring on Goldman in just a bit, but let's talk about the roundup of the banks. As Alexandra just highlighted, we did see a big drop in profits when you look at the year-on-year comparison. A lot of these banks beat expectations, but it certainly didn't really bode well when you look at the outlook here. You think about the concerns in terms of loan defaults, loan loss reserves increasing as well. I mean, what did you take away from these results in terms of the economic picture to come?
Sure. Well, I think it's a complicated environment, right? The macro backdrop has been complicated all year. And, even as we're about ready to exit 2022, there's still a lot of uncertainty. And so we haven't really made a lot of progress on that front. And so banks kind of being one proxy for the outlook of the economy, there's obviously a wide dispersion of expectations. That being said, what we're actually seeing in the results is pretty encouraging, at least as of now. Really no credit issues. Higher interest rates are driving guidance higher for net interest income for the most part. And then, as I think you guys talked about, investment banking is very weak off of what was by far a record 2021. On the other side, trading is helping offset that. So it's just showing that these are business models that are pretty resilient. The bar was low into earnings. But the macro outlook is still uncertain. And so that's why, we think we've been arguing we're kind of in this range-bound trading where we got a little bit oversold. People were a little bit too negative, and now you're seeing a bounce off of that. But until there's more certainty and stability, it's going to be hard to have really a sustained recovery in the stocks.
Let's talk about the other big announcement getting a lot of attention here. Goldman Sachs essentially confirming these reports that came out of multiple media outlets, including the Wall Street Journal, that they are in fact restructuring here, going from 4 divisions to 3. There's a number of things to highlight: the consumer business and wealth management merging with asset management, also investment banking and trading now being placed under one unit. What do you think this says about where the bank is headed? Some would argue, well, there was this big focus, back in 2020 about the consumer side of things. Is there a pivot that's happening?
Yeah, I think this is more of a reorganization around the edges. This isn't some major shift in strategy or major pivot. On the consumer side, they're I think listening to the market, and there's a lot of press out there that it's not a profitable business today. It's growing at a pretty strong pace. Consumer revenues are up 95% year over year, but it's a business that I think is still spending a lot of money to expand. And so I think they're pulling back a little bit on that growth investment. I think they're getting a little bit more specific around how they acquire customers, and you want to do it in a more profitable way. And so those are where some of the changes are. The reorganization of the business units to me is more just getting a little bit more organized around how they report, how management is structured. Don't really see a major strategic shift there, but ultimately, maybe that drives a little bit more efficiency in the business model. But ultimately, Goldman is it's the same business. They've gained a lot of market share on the institutional side, and we don't think they're pulling back dramatically on consumer. I think they just want to be a little bit more tailored and be a little bit more focused on profitability there.
Yeah, I mean, it's not a dramatic scaling back, as you say, on the consumer side of things. Having said that, it's taken a while for that to be a big driver. Do you anticipate that will ultimately take hold, or are we just sort of talking about through the traditional revenue drivers remaining in place for the bank?
Yeah, so I mean, Goldman's a little bit of a victim of their own success. They've had so much success on the institutional side, and those revenues have grown more than I think most people predicted a few years ago, that you look at the growth in consumer and say, well, it's still relatively immaterial. I mean, they're generating over $2 billion in consumer revenue. So it's not a small business if you took it out and put it on a standalone versus any other digital bank or new consumer startup. So we do think it's something that's going to take hold. Goldman's not managing the business for the next credit cycle or the next 2 years. They're managing for the next 20 years or even 100 years. And so when we think about getting into an entirely new business line that is a huge addressable market, it's going to take time. And they're just listening, I think, to market feedback and pushback that, hey, you need to get this business into a better profitability picture before you continue to add new legs to it. And so that's really kind of what this is. But we're still pretty constructive on what consumer can be in the long term, and think they'll continue to feed growth there, and just be a little bit more tactical around how they do that.
Specifically on Goldman Sachs, you've got a price target of $470 a share, an outperform rating there. How do you think it stacks up against some of the other banks that have reported in the anticipation of some kind of economic downturn?
Yeah, Goldman historically has always gained market share coming out of economic downturns. So, in that very moment of market stress, it can be challenging for them as it is for everyone, but they are so good on risk management. And when others essentially get out over their skis and take too much risk, Goldman Sachs is able to really gain market share, take clients, and that's what we think would happen again to the extent the economy does roll over. So again, you're not cheering on a downturn, but ultimately Goldman Sachs is going to be better positioned in our opinion. And so when you're buying the stock at just over book value is $308 for them right now. That's a pretty good risk reward long term for investors that can be patient. They're generating returns on equity north of 10%, even in this really difficult environment. That relationship has always helped investors, in our opinion, make money when that ROE and book value are correlated like that. So we think this is a pretty good entry point for investors that have a little bit of patience and a little bit of a long-term orientation.
Devin Ryan, JMP Securities Director of Financial Technology Research. Good to have you on today. Appreciate the time.